Amidst a challenging economic outlook, volatility seems to be the word on every investor or trader's lips that I speak with on air. Today we're asking, are there better approaches than just sitting on the sidelines as a retail investor? How can you best allocate your funds given today's money market? And what can we learn from an investment strategy that says in the midst of all this volatility, some psychological safety of having a retirement safety net of maybe $1 million in your CPF could help you make intelligent decisions on the market. We're going to learn about that retirement strategy and investment strategy in just a while. But first, time to meet my 6-man panel. I'm feeling really good about being a woman now. The only one here. You heard from Christopher Tan and Song Seng Woon, so I'll ask everybody else to please introduce yourself and share your initial thoughts on the topic. Jeff, you want to kick us off?
My name is Jeff Howie. I'm the market strategist at Singapore Exchange. I've been in Singapore for a little over 10 years now, and I know a lot of the investors who are here today. I guess the thoughts on what we're talking about. I guess, Michelle, it's counterintuitive to be saying stay on the sidelines, because central banks across the world are cutting interest rates so much that the bond market that Christopher was talking about, a quarter of the global bonds are actually negative yielding, and hence there are some pretty more modern ways that you can interact with your financial service providers now. There's ways to basically mitigate against some of the volatility risk. There's a number of products out there that are very well diversified and basically giving investors access to different, I guess, ways to invest in the market that can be more suitable to their own individual risk appetite.
That's a great top line. Terence?
Thanks, Michelle, and good evening, everybody.
Hey.
Yeah. Anyway, Terence here. My money is 10 years, right?
Indeed, it is.
Yeah. I've been a professional for the last 20 years. This is my 20th year.
Are you bragging about looking so youthful?
Okay, anyway, 16 years of which as an analyst. The last 4 years I started a fund management company. So of the 16 years, I think I have a very, very eventful time with SIAS Research. I started SIAS Research back in 2004. So many familiar faces here. And many of you know that I'm very passionate about the Singapore market, very passionate about small caps. And last few years have been very, very hard pain. Jeff has been here for 10 years. He understands what hard pain is. It's very hard pain for me. I look at the market, it lacks liquidity. Everybody say it cannot make it like Singapore market. So I have been on a crusade for the last 4 or 5 years, and this is about reviving the Singapore market. I believe that there are a lot of good stories to tell. There are a lot of good investments out there. Many of them are going so cheap, and it is only because people siam after the 2013 ABL case, and of course earlier on there's the 2008, 2009 S-chip debacle. So a lot of people, I understand that they only want to invest in REITs, in DBS, in Singtel. But I'm telling people there are a lot of exciting stories out there here. We cannot be a first world economy with a third world stock market. So let's put our heads together. Let's put our wallets together and look for good ideas. And that's why I'm here today.
You have my wallet, that's for sure. Mr. Chan.
Hello, everybody. I work for CFA Society Singapore as an executive director. I write and research on market integrity, the capital markets, and investor protection. I'm going to echo what Terence has just said and what the speakers before me have said repeatedly. In a volatile market or any other market, you need to diversify. The general principle that we always put out there is very, very simple. Do not put all your eggs in one basket. And for all the financial literacy talks, we have emphasized that again and again and again. So I'm hoping that when you go away, you look at your portfolio. Everybody has a portfolio. Are you diversified enough? Is your portfolio diversified enough? Ask yourself that critical question. Because many a times, short interviews, chit-chats with many, many people, and even blogs out there, they have income-generating investments, because interest rate is very, very low. In the West, sometimes it's negative, and there's this rush for yield. And I find a lot of investors, they go, oh, they have, let's say they have 50,000, 100,000, 600,000, and the majority goes into one particular asset class, which is it still diversified? Yes, because instead of buying maybe another condominium and you pay off the condominium in 20 years and you get retirement income, they put it into a diversified vehicle called REITs. And it's exclusively in REITs. And they say, oh, is it generating results? So yes, it is at this juncture because they're drawing $1,000, $2,000, $3,000 a month. And so perhaps you would want to look at maybe small caps. In SGX, some do give dividend yields as well. Look into the different asset classes and looking into fixed income. They do have yields as well. And looking, again, maybe some markets in overseas. But yes, SDI do give quite a good dividend yield at this juncture. Yeah.
Thank you, Mr. Chan. Mr. Liu?
Okay, my name is Lou. I am a big advocate of an investment vehicle that every one of you guys have, and none of these guys are talking about, is your CPF. Okay. First of all, I need a caveat that I don't work for the government and I don't work for the CPF. Okay, and some of you may have a political view that you don't like the government. Some of you don't like the PAP. Some of you like the CPF board. It's okay. You just need to love their money. Okay, so thank you, sir. Okay, so I'm a big advocate that you put your CPF, your funds in your CPF special account. Okay, and don't touch it. Put as much as possible, as young as possible, and let the power compounding of the 4 to 6% just run by itself. Okay. And over time, you and your wife combine together. If you just leave it there, if you max out your FRS, which is your full retirement sum, which is the CPF minimum sum, when you're young, your early 30s or late 20s, it will shoot up all the way to way past $1 million. So I've coined this terminology 1M65, means $1 million by 65 years old. Some of people say, "Ayya, Mr. Lu, how on earth you can do it? No kind of thing." Okay, just let you know, me and my wife just crossed 1M45. Okay, so it's possible. It's not because I'm richer than you. Thank you. It's not I'm richer than you. Okay, because CPF got cap. There's a cap. So you rich also cannot top up. Just because we started early. Okay, so just to share with you, I started this movement to encourage everybody. Form a financial safety net of a path to reach $1 million and your life will change. Okay, that's in a nutshell. Thank you.
Fantastic. Okay, let's jump into your questions. Over 30 people want to know the answer to this question. Which sectors should we focus on in 2020 in the Singapore market? Which sectors can be strongly considered for continuous investment at this time? Singwoon is arrowing you two over here.
Okay, for myself, I look at a few sectors. I think the offshore marine is, I know a lot of people hate the offshore marine sector. And disclaimer, I actually mentioned offshore marine at the start of this year and I was wrong. But I think that I cannot be wrong for many years, right? So next year, I'm taking another step at it. I think that there should be some form of recovery. And I believe that the Keppel deal by Temasek actually gave it a bit of confidence, a jolt of confidence. And I think that in terms of Temasek family, there's going to be a little bit of a restructuring. In fact, it's ongoing. And a lot of people are pointing towards Sembcorp Marine. Of course, after the deal was announced, Sembcorp Marine popped up a little bit. And then lately, because of the bad results, came off. But I feel that something is going to happen and it's going to be sooner rather than later. So that's something that I believe that you can look out for. But in terms of sectors, actually I look at some of the sectors and I think that property looks relatively interesting against, say, REITs. A lot of people compare REITs and property, and they've been lapping on the yields. And REITs have done very, very well over the last few months. Of course, lately has seen a little bit of profit taking, but REITs have done well. But in 2020, I believe that property is going to go ahead or run ahead of the REITs, and for a simple reason that property counters have been sort of underperforming the REITs. But fundamentally, if you look at the property prices, I believe that it's going to start to inch up. Demand-supply dynamics, interest rates, at the early part of this year, we thought that interest rates were going to shoot up, but instead of shooting up, it's coming off. So that's going to be good for property on the demand side. And remember, there's an army of people in 2017 that were displaced because of en bloc activities. So these guys are going to come out, they're going to start, or they've already started to buy apartments, and you can see some of the better placed apartments that are reasonably priced. The take-up rate has been actually reasonably good. We're not talking about the 2017 type of good whereby, immediately you can see 50, 60% take-up. You see 30, 40%, but slowly they're biting away. And the government has also, on the supply side, reduced the GLS, the government land sales. And we are talking about, for this half at least, in 2019, the government land sales have been at a 12-year low. So with supply coming off and demand, I think, slowly picking up, this is going to be good for property stocks. And if you look at the discount to RNAV, the big caps are discounted about 25 to 30%. The small caps are discounted at 40 to 50%. So that's great. Another one, I think, very quickly, construction. Construction activity, it has been a great challenge over the last many, many years. In fact, the last time construction stocks actually did well was 2006 and 2007. 2006, it was the second best performing sector. In 2007, it did also very, very, very well in the first, I think, the first 3 quarters of the year. Construction has done very well, but after that, it's been challenged. The margins have been crimped, but I think that they ought to make a comeback right now with more construction or more contracts coming on stream. And remember, the last time we did well was because there were the 2 integrated resorts. Phase 2 of RWS and MPS is coming through the next few years, and they are in a hurry. So I think that that's going to be great for construction companies.
That was fantastic. So, Jeff, you track Singapore-listed companies quite closely in your role at SGX as market strategist. Which sectors have been performing well so far, and would you like to add on?
Sure. I'll just cover 3 sectors to add on to what Terence was talking about, and it very much tells the story of what's happening in the world. So, at the moment, as Song was saying, we're in a synchronized downward trend in that growth premium that we've seen. So growth is decelerating. We're not declining per se into the negatives, but there's been a global decline of growth. And the thing is, it's not just in Singapore, it's across the world, and all the ammunition across the world is being harnessed to solve it. And we've seen 3 rate cuts, successive rate cuts by the Fed Reserve. And that's had a pretty big impact on the interest rate sensitive sectors across the world. So we've seen REITs perform really well this year, as you said, 20% returns on average. But REITs have also returned 20% on average in the US as well. So basically those rate cuts in the US are to address the same issues we're facing here, and hence you've seen quite a lot of the global stock market in sync as well. With the interest rates coming down, of course, net interest margins for the banks also come down, and hence we've seen our banks here perform pretty much in line with the world's big 50 or the big 100 banks. So REITs have outperformed double the returns of the banks this year. In terms of technology stocks, they've also been very prevalent in our day-to-day turnover this year. If you look at the likes of AEM Holdings, if you look at UMS Holdings, if you look at Franken Group, if you look at Hi-P International and Valuetronics, those 5 stocks, those handful of stocks in the first 10 months of this year were averaging around $20 million of turnover a day. If you look at this last 5 days this week, those 5 stocks were trading around $40 million a day in turnover. They've effectively doubled this week. And that's because there's a lot of, obviously, focus on tech. From the early days of the trade war, there were talk that this was about who controls the race to win 5G, because all the 5G technologies over manufacturing, transportation, agriculture, info commercial services, that's going to be a $12 trillion economy by 2030, which is the present size of China. There's obviously, like Huawei, for instance, had thousands and thousands of patents on 5G technology, so we saw that come to the front with the trade war. Basically, the US not allowing Huawei to operate there because the US want to win the tech race. So I guess what I'm saying is there's all these big global forces, all these big headlines that you can catch in the newspapers, on Money FM, on the TV and so forth, where we're talking about what's happening in the US, what's happening in the tech race, what's happening with interest rates, what's happening with Europe. The good news is it's all really relevant to the Singapore stock market. Everything that we've seen in our stock market, right down to looking at the actual performance of the different REITs within the big REIT sector, you've seen a lot of correlation with those sectors with global sectors. For instance, data centers has been the strongest performing part of the REIT world. There's only 800 or so REITs listed across the world. The world's biggest real estate stock is actually a REIT. It's a tower, a communications tower, American Tower Corp, and that stock has actually outperformed Apple in the year to date. So data centers and communication and so forth and technology has been a key, I guess, theme across the world, and we've also seen that play out somewhat in Singapore.
Just terrific. Thank you so much. I was speaking with a lot of the people here during the breaks outside, and I realized there are a lot of retirees in the audience, and they want some help when it comes to instruments that they can use. They're worried about being too aggressive or not being aggressive enough given the runway that they have. I wonder if you can address some of these concerns. What should they be looking at, the retirees?
Okay, I'll try that. I think like what Lou said, actually the best retirement instrument here in Singapore is actually your CPF. So the first thing I think we've got to check is whether you have topped up your CPF, because your CPF forms the safe retirement income floor. That gives you a consistent stream of income regardless of market, and it hedges against longevity risk, no matter how long you live. Money's in your RA, you get 6% for the first 30,000, 5% for the next 30,000, and then for the remaining of the amount in your RA, you get 4%. And you are getting 4, 5, 6% at AAA risk. You can't get this anywhere out there. So I think the first thing to look at it for a retiree is, when we are retiring, I just spoke to a group of retirees this morning. When you are retiring, yes, return on investments or ROI is important, but I think ROI, reliability of income, is even more important, because you don't have any more income. You need to preserve your capital. You need that reliable source of income. And CPF should really be the first instrument to look at to form that safety net. And after you have done that, because there's a maximum, unfortunately, that you can put in, as at today, you can only put in about 264,000 in your RA, nothing more. Yeah. And after you have done that, and you still have excess cash, then what do? Well, if you've got excess cash, you can invest it in the market. But my suggestion is you bucket it. There will be monies that you need immediately the next 5 years. Please keep that in cash, because you don't want to be investing and the market goes down and you need to withdraw. You get hit by a falling market and you have to sell. Then you get a double whammy, right? You sell and when the market is coming down. There will be monies that you really don't need much later, because retirement is a long time. Yeah, retirement, you have time horizon. You're going to be alive for the next 20, 25 years. So there will be money that you don't need in future years that you can actually increase that exposure to the stock market, because it is the stock market that's going to give you that return. It is the market that is going to beat inflation. Of course, you can buy stocks and you can take sector bets, and all that. Yeah, but, and I'm not saying that's wrong. It's just not my way of, not my preferred way of investing. Yeah, because for me, when I'm actually managing money for retirees, I know that capital preservation is very important. Yeah, I don't want to take a bet. So what I do, okay, I rather let everybody take a bet, and I take the average return of their bet. I don't know whether I'm clear here. Now, sometimes I ask that question, would you like to have all these smart people here in your investment committee? Would you all like that? Would you all like to have like George Soros, Jim Rogers, Warren Buffett and all that be in your investment committee advising you? If you want that, just buy the index, because the market is an average return of everybody's decision, right? Yeah, if somebody thinks it's better to buy this stock, somebody thinks it's better to buy that stock, it's the average decision. Now, you're not going to get the best return. You're not going to get the worst return either. You're just going to get sufficient return. Isn't that what is important in retirement? Enough returns? Because if you want to have an adventure,
the stock market is not the place. MBS is a better place to have an adventure. Yeah? So that's my conclusion to the matter. Thank you.
Thank you. Mr. Liu, please.
Just to add, first of all, I told you I'm a big advocate of CPF. A few things you should do. Number one is that CPF Life is an incredible high return annuity fund. Try to top it as much as possible. I think the max you can do is 264,000 in your RA. Don't underestimate the amount. Second is that there's a CPF hack that's going on right now that before I reach 55, what you can do is that your SA, what the government does at 55 years old, they take out first from your SA amount of I think $176,000 and put into your RA. Now the SA has a 4 to 6% return. Now it's very high, 4 to 5% return. Okay. Now what people does, and they taught me, I was taught by Lorna Tan of Straits Times, he published it. They actually bought take that amount, buy some instrument that is admin fee free, some bonds. They take out the amount of money. So at 55 years old, the entire 176,000 will be taken from your OA, okay, into your RA, which means that they take out funds from a low interest, which is about 2.5%. And after the fund tumba into the 176,000 RA, then you can sell the equity that you bought your SA with and return back. In short, what you're doing is that for $176,000, you actually max out the full return on your SA, and then your RA also max it out as well. So that's a CPF hack that's going on right now. I thought it's very smart. I asked CPF, are you going to plug the hole? They kept quiet, okay? So, but their point is that, their point privately told me is that I don't see a reason why we should stop that, because it helps people to retire. So I thought these are things you could do to max out your CPF. And after you do that, your retirement should be pretty comfortable. Then, you think about what Christopher has said, put some in the long-term index funds and all this. I think that helps. Okay, thanks.
Please. Mr. Chan.
I will keep this short. Just for the record, I support the CPF returns. They're excellent, the alpha. I'm just going to add one more point. When we get older, like my late father, sometimes we are not as sharp anymore. Our mental faculties do deteriorate. I think I'm good now. I can manage your own money. But I don't dare to say the same when I'm 70, 80, 85. And sometimes if you look at the annuity, some of my friends, even my better friends, they go, at 55, I'm going to just put the basic retirement sum and take in less money. And thereafter it follows complaints after complaints and after complaints. And they just wonder why people might go for the enhanced CPF sum. But for me, I think I will consider that because at 70, 75, 80 years old, before you actually invest in a stock, do you have the time? Do you have the cognitive capacity to research, to take in the advice from the experts and go, where should I invest? You don't really want to lose a bulk of your money when you are at 65, 70, or 75. And it's a very, very bad thing to do.
So I want to pick up on that point of trust. Yes, wonderful. That trust in financial advisors. Mr. Chan, CFA, I understand, is looking at the structure of commissions tied to KPIs. Chris, you wrote a great article. One of your earliest articles for the Straits Times, quite controversial, was extremely critical of commissions in the insurance field, that you were a long part of that field yourself. So you're writing about, what you saw from the inside. So people wonder, can I trust my financial advisor if remuneration incentives are tied to commissions? What do you say to that?
We should read the Australian newspapers following the big Royal Commission into financial services in Australia, which was quite revealing, actually. Very different. Obviously, Singapore and Australia.
But they banned commissions?
No, they were doing all sorts of things. Very commission-driven, very commercially driven. And in the end, Australia had to have a royal commission into the banks and look at changing the culture in the banks. But you know, I'm just throwing in some context there for you.
Chris?
I mean, without doubt, taking commissions or commission is a source of conflict of interest. It's without doubt. If financial advisors get compensated by commissions when dishing out that advice, you will always be thinking whether when this person gives the advice, is it really good for him or is it really good for you? But does that mean that all commission-based advisors are dishonest, unscrupulous, and all they want to is to make money from you and they don't give bad advice? I think it would be a bit too harsh to say that, because there are good advisors out there. It's just that they choose to be a commission-based advisor. Yeah. I'm a fee-only advisor. I take a fee for advice. I don't take commission. And the reason why I do that is because I believe that if I take commissions away from advice, it doesn't make me any more honest, but it takes away that temptation, that I wouldn't be tempted. Now, so if you are working with a commission-based advisor, be brave to ask this question. How do I know, or how are you mitigating this conflict? Even as a fee-only advisor, there are still conflict of interest. This whole conflict of interest cannot be taken away completely. No way. We can only do so much, but at least we must be able to provide you an answer how we are able to reduce that conflict. So if you are working with any advisor, for that matter, but especially commission, because, like I said, that's the source, ask that question. Yeah? I know that you're taking commission. I know that this is a source of conflict for you, and I'm perfectly fine as long as I know it. But can you please tell me, how are you going to reduce that conflict for me? And if you are satisfied with that answer, you can work with that advisor. Of course, this advisor, as a given, must be competent. You must like the advisor. That's very important. I'm not joking. Because an advisor is someone that you want to work with your whole life. And if you don't like the advisor, you cannot have a proper conversation with the advisor. You don't think the advisor is able to coach you in difficult times, then no matter how competent, how conflict-free, you probably do not want to work with this guy. It's like a doctor, right? This doctor can be the most competent doctor. He can charge you a very good price. But if he has got bad bedside manners, you wouldn't like to work with this doctor. What makes a good doctor is the bedside manners, how much care he shows you, right? And so above all this, you look for, above all the commission and conflict thing which I've shared, look for some of these things, and you feel comfortable, work with the advisor, start small. But let me end just by saying this. It's your money, really. An advisor is just there to partner you, and that's why we do these events like this, so that, we get educated as well. I think it's totally irresponsible just to pass it to the advisor and say, I don't want to know anything about it. I think we should know as well, so that as the advisors advise us and we think through and we say, it sounds reasonable, then you can work, and I think you can work better with your advisor. All right, thank you.
Great answer. Thank you. Okay, so here's another question from the audience. People love investing in banks in Singapore, right? So with the rising trend of digital banks, and I read somewhere fintech is eating banks for lunch. So what will the future of traditional banking look like? What does this panel think? Seng-Woon, I know you hosted a whole panel on the future of banks, so you have to have something to say on this.
Ultimately, I suppose it is your money. So I suppose it's all about trust, right? Back at what Chris talked about earlier, whether it is your financial advisor, it is who you put your money with as well. If it is somebody that you don't know, are you going to be comfortable with it? So ultimately, it's really about, again, same thing, trust. Whether you can trust something new that's coming through, or whether something old, which is now rebranded with a digital name inside as well, because technology has progressed. So ultimately, it is still about, but beside technology, it's still really about trust. Whether you can trust that your money is still where it is supposed to be when you go to sleep and when you wake up. So nothing more to add to that, I think.
Maybe I'll just add something and say that we can't avoid the fact that, we are going into a high-tech world. Everything is, into tech. Today, even in investments, there are plenty of robo-advisors out there, right? And last count, I think there are like easily 10 robo-advisors in Singapore. But I always say this, that I don't think technology is ever going to replace human beings. Never. Never, ever. Because God did not create robots, God created human beings. Isn't it true? We are the people that built the robots. Beyond that technology, whether it's a digital bank, whether it is going to be a robo that you are using, and I totally agree with what Mr. Song said, that it has got to be the trust. How do you establish, how do you feel you can trust? Ultimately, it's the people behind the tech that is important. And so before you decide a digital bank that's going to come, I'm quite excited about a digital bank because I think it's going to lower the cost. It's probably going to get a much higher interest because the cost is lower. I'm quite excited. Yeah, but before you start putting your money in the bank or in that digital bank, look at the people behind that digital bank. Who is running it? Can you trust the people who are running it? It's a fly-by-night company. Have you heard of that brand name before you make that decision? And don't put all your wealth there. Start small, right? Start slowly until you're a bit more comfortable. Then you go in a big way. And you don't transfer your $10, $20 million right into that digital bank. I hear silence because you agree that all of you have 20 million, right? Oh, sorry, I insulted you. I said, what, 20 million? I've got more. Yeah, just transfer a bit, and then when you get used to it, then you move in the rest. Yeah, thank you.
Thank you. Okay, this one I think is for you, Jeff. Terence, you might want to jump in as well. The Singapore stock market seems lackluster with more and more delistings. What is the future of the Singapore stock market, and are we better off investing in other stock markets?
Singapore stock market generated 9% annualized total returns in the 10 years coming into 2019. And then this year and the year to date, it's also generated 9% returns. You can't say those two stocks at the top of the turnover table, DBS and Singtel, are lackluster. And those two stocks have performed very similarly this year, but very differently over the very different months. So, come May, when trade tensions picked up again, big time in 2019, all the way through to September, we saw Singtel outperform DBS by as much as 20%, and that was basically seeing a lot of institutional interest into Singtel, and basically interest rate outlook come down as well. So there are a lot of key drivers for that. There's a lot of diversity in the stock market. Just saying that our two biggest stocks by market cap, for instance, have very different dynamic behaviours. You can look beyond those stocks. If I was to assume that, okay, you want to give it a second look, that you want to look into the market, then you have to have a couple of rules too. You have to, you can't just look at one stock. You have to look at multiple stocks, because it is, again, the stock market plays to many of Singapore's strengths as well, in that it is highly diversified. There is a lot of, company names that have been with us for the last 50 years or so, that have built a lot of businesses that are diversifying their business streams all around the region, and they're in tune with the global themes. As I said before, data centers has performed really well in the US this year, and we've seen some of that too. Mapletree Industrial Trust, when it first listed, it did not have data centers. Then 18% of its portfolio is data centers. Now 30% of its portfolio is data centers. So these are the big names, the big stocks that are moving with the times, and if you are investing over a long period of time, you want to be investing in what some of the key drivers of our economy are over the time. But that's the last point I want to make. Investing over time, you don't have to just put all your eggs into one basket, into one stock, and you just as likely don't have to put all your money into one trade at one time. You can, what we call TWAP, or dollar cost average. That is, put in a set amount of dollars maybe every month or every quarter, and just basically mitigate some of the risk that you end up buying at the very high of the market. If you spread the capital for your investment in that particular stock over many months and over many years, as you can imagine, you won't get the low of the market, but you won't get the high either.
Terrific. When people hear the Dow was up 20% year to date, and we talk about diversifying, is it a good idea to look at other geographic markets?
Yeah, it went through 25,000 last night for the first time ever, I think. Yeah, and there's a lot of diversity here in our stocks. We've got a lot of companies that have, this is why we are now seen as a global or a regional hub for many different sectors in our market. For instance, we have a lot of companies that have, as you know, China businesses, Malaysian businesses, Indonesian businesses, the Australian business connections are even kicking off. So there's a lot there. And also there's the importance of spreading it over time. All the big investors, all the big global institutional funds that are basically investing in those mutual funds that you would be invested in, they are investing across the world. They're investing in FTSE World Index, for instance. They're investing in the big global indices that do have Singapore representing pretty small amount, because remember we're 0.4% of the world's economy in terms of our GDP. We're also 0.4% of the world's market capitalization. We're also 0.4% of the FTSE All World Index. But there are certain sectors here where we have a lot of strengths, where we do punch well above our weight. For instance, in real estate, if you look at all the real estate stocks that are in that FTSE All World Index, when institutional investors look at those number of stocks, those almost 200 stocks or so, 5% of those stocks are actually listed here at SGX, which is pretty incredible. So there's many aspects of our market that do have a lot of good international solid impact that we have, and that's, as you say, and as I said before, what some of the great things in our economy do transcend into our stock market. As I said, we're 0.4% of the world's GDP, we're 1.6% of the world's trade, and hence we've got a lot of international and businesses that are basically basing their assets overseas or generating revenue. And not just listed companies from overseas that come from overseas, but so many Singapore businesses that are building their businesses overseas as well.
I want to squeeze in one final question from the audience. Time is ticking down. Warren Buffett says diversification is for people who don't know what they're doing. Any comments? Shall we go down this way? Yes, Mr. Liu.
I actually wanted to answer the question following the comment on SGX. I think it's very important to look at, when we say diversification, for example, if you were to buy the STI index, and if you buy it right at the high before the Lehman Brothers crash in about 2007 or 2008, it was about 3,800 points. Yes, crash, and then it's recovered, crash, recovered. Today it's at 3,200 or 3,300 points. It has never recovered since then. So I'm not trying to say that SGX is bad. I'm saying STI is bad. So there's a difference, okay? There are stocks in the SGX that are very wonderful. We should look at them. So when you diversify, let's say diversify buying the STI index, if you buy 10 years ago until now, you're still negative, right? So now, but if you bought the S&P 500, it has grown from strength to strength. Way crash. So in that sense, when you diversify, you have to diversify at the right place, right? When you diversify at the wrong place, you may never recover even after 10 years. So I think that's a comment I just want to add on. So just to add on, just to answer the question, yes, diversification is for people who are not doing it, but most of us are ordinary investors. I think diversification may be the best option unless we are Warren Buffett caliber. That's my opinion. Thank you.
Thanks, Lou. Can I make a comment on this? Okay, firstly, it's a very difficult question to answer because there are so many aspects of it. Yeah, but I'll say this, that, if you want returns, you can't run away. There are many other asset classes out there, but it is the stock market that gives you that return. Not so much bonds, but really the stock market. But to have a successful investment experience, you need to stay long, you need to stay invested long enough to be able to get that return. The problem is that we are not Warren Buffett. The problem is that our head and our heart cannot connect. We understand that we have to stay long enough, but when the market starts to go down, when you hear news on radio, on TV, and you read it from the newspaper, and you hear comments like, this time is different, it's going to collapse, whatever we have in the head, all these 10 years of education and my money is going to go out of the window. You can't take it. And therefore, we put in other asset classes, we diversify into other asset classes like bonds, for example, to stabilize the portfolio so that the ride is not so bad, so that you can stay invested long enough to get the returns. And this is not from me, this is from the late John Bogle. You put in the bonds so that you moderate the ups and downs of the portfolio so that you can stay longer. And one more thing, sometimes we need other asset classes because of our time horizon. If you need your money in the next 5 years, in the next 3 years, surely you cannot just put everything in stocks. You need to put into something else. Yeah, so I would think it would be too, I wanted to use simplistic, but that would be so much disrespect to Warren Buffett. But you know Warren Buffett, when he invests, he has no timeline. He invests forever, so he can say that. But I think for many of us, we've got to understand ourselves better. So I will respectfully disagree what he say, that diversification is for only investors that do not know. I don't think so. Yeah, in fact, diversification is for investors who know themselves. And that's why they diversify. Yeah.
Well, thank you to my blockbuster panel. Would you like, okay, one more.
Just a short
Will you
one,
stay
right?
with us for one more minute?
Warren Buffett does diversify. He doesn't put all his money into Coca-Cola. It's into a couple of businesses. And just to latch on very, very quickly, to understand yourself, you got to understand, do you have the time? Your job takes you from 8:30 until 6, 7 o'clock. For me personally, I don't know anything about investing. I don't know about sectors because I don't have the time. Not that I do not have the skills. So very, very simply, because I do not have the time to understand the business, do I put monies into a couple of sectors? I don't. It's put it with the professional fund manager, the ETFs. They diversify for you into different asset classes. Yeah, because I just don't have the time. I understand because I spend more time on investing. My boss calls me up. What are you doing? The deadline was a week ago. Yep.
One more thought from Jeff.
Yeah, sorry, one more thought. There's also the Piyush Gupta school of thought as well, which you don't end up diversifying, you actually end up concentrating. So you might start diversifying over a number of different stocks and then you start to concentrate on one or two or less stocks than you started with. But I guess what would enable you to do that, what would empower you to do that is education. And obviously, I know Mr. Gerald, Richard, they're always at the OSGX Auditorium with a number of educational events, helping investors to know more about the trading and the investing so that you can make that most informed decision when it comes to it.
Well, thank you very much. You've done my closing for me. Ladies and gentlemen, a round of applause for the panel.